What if the silver price flashing on your phone screen right now is completely a lie? What if I told you that while you were asleep, one of the most blatant financial robberies in modern history was just carried out in front of the entire world? Right now, as you're watching this video, your financial future could be threatened by what just happened in the silver market. If you own any precious metals, if you're considering buying silver, or if you simply want to understand how the financial system actually works and how it manipulates us, you absolutely cannot miss what's about to be revealed in this video. But before we begin, I want to clarify one thing. I know some of you leave comments doubting that this is fake rumor, AI-generated junk content, or some kind of propaganda. The avatar speaking to you might be an Asian person, but behind it, I'm just a silver investor with the same passion as you. I'm the one staying up all night, constantly refreshing charts, tracking every real-time development in the trading market to bring this information to you before anyone else. Every data point, every price level, every market signal discussed in this video is verified, with clear sourcing from public exchange data that you can check yourself. This channel doesn't sell courses, doesn't sell trading signals. We only provide the truth. So please support me by watching all the way to the very last seconds, because the end of this story contains information that could be decisive for your wealth. Let's rewind a few hours. The silver market was in an extremely strong posture. After weeks of quiet accumulation, silver started to break out. It pushed through resistance levels, absorbed all selling pressure, and drove straight up to $90. And then, at 12:48 a.m., New York time, late at night, seen during the thinnest global liquidity window, silver punched through $90 and hit $91. That $91 price wasn't just a meaningless number. To hedge funds and trading algorithms, it was a massive psychological marker. When price hit $91, breakout chasing algorithms started to trigger. Options dealers who had sold call options at the $90 strike suddenly found themselves in a dangerous position. They were forced to buy futures contracts to hedge their risk, delta hedging, creating a mandatory buying loop that pushed price even higher, an effect Wall Street calls a gamma squeeze. Short sellers, the big banks that had bet billions of dollars that silver would fall, were getting backed into a corner. If they allowed $91 to hold, it would trigger a massive stop-out wave, pushing price to $95, then $100, and blowing up their entire trading books. And that's when the unbelievable happened. Right when momentum was strongest, the world's largest derivatives exchange, and CME Group, suddenly went dark. No warning, no sign beforehand. All precious metals and natural gas futures on CME's Globex platform fell into darkness. Natural gas came back after 35 minutes, but metals, gold and silver, were completely frozen for 90 minutes. An hour and a half of absolute silence on the most liquid metals exchange on the planet. CME's official explanation? 2 words, technical issues. No independent audit report, no detailed explanation, just technical issues. But listen, do you really believe that coincidence? Do you believe that America's financial infrastructure, secured and funded by billions of dollars, just suddenly broke at the exact moment silver threatened to incinerate gigantic short positions? What happened during those 90 minutes of darkness is the real crime. While you and I, retail investors, were completely locked out of the market and couldn't do anything, the exchange quietly executed a cleanup. CME's system canceled all-day orders and all good till-date orders that were sitting in the system. What does that mean? It means every retail investor who carefully placed a buy order at support or a protective stop-loss order got wiped out. The order book was stripped clean and rebuilt from scratch. Who benefits when an order book gets wiped? The big institutions, hedge funds with co-located servers sitting right next to the exchange, those who can slam thousands of new orders into the system within milliseconds. But the most terrifying secret isn't in the orders that were erased, it's in the orders that were quietly executed. While the exchange was supposedly fully shut down due to a technical failure, the data shows that 31,828 silver contracts were traded and cleared in the dark. 31,828 contracts. Multiply that by 5,000 ounces per contract. That's nearly 159 million ounces of silver, equivalent to about 20% of total annual global mine supply, changing hands during a time window when no retail investor could see it or participate. This is not an infrastructure glitch. This is a managed reset. And the instant the trading gate reopened, right the moment the light returned to the electronic board, silver didn't get a second to breathe. It got slammed. Price fell in a vertical line, dropping $3 in just minutes from above $91 straight down to $88, then continuing to get crushed into the $86 area. No pause, no bottom buying was allowed to exist in those first seconds. It was like a wall of short selling was dumped directly into a market that had just been drained of liquidity. The free fall through $90 triggered a brutal chain reaction. Stop-loss orders from thousands of retail investors fired automatically, turning them into forced sellers. And one person's stop triggered another person's stop. Margin calls erupted everywhere. This 5.5% drop in a single session wiped out billions of dollars in notional value. Investors who had just excitedly bought at $91 hours earlier were now forced to watch their accounts evaporate. They call this a market correction. They call this profit taking. That is a lie. This was a deliberate attack, a forced liquidation event, algorithmically designed to slaughter weak hands and reset the market ahead of a life or death deadline. So why did they have to use something this extreme and this obvious? Why did they have to pull the plug on an entire exchange? The answer is inside the COMEX vaults, and this number will make your skin crawl. Registered silver, meaning the physical silver that is actually available, as SAID, auction ready to be delivered for futures contracts, has just fallen below 100 million ounces. In fact, the latest data shows it's only around 87.2 million ounces. Compare that to the past. 4 months ago, it was 167.7 million ounces. We are watching a 40% to 47% depletion of the entire deliverable silver supply in under 120 days. On average, about 785,000 ounces of physical silver leaves these vaults every day and never comes back. Now compare that 87 million ounces to open interest. Amount the total paper contracts demanding silver delivery represent more than 662 million ounces. Or, in the March and May contracts, the figure runs into hundreds of millions of ounces. You're looking at an insane leverage ratio. For every 1 ounce of real physical silver in the vault, there are 4 to 7.5 paper ounces claiming ownership of it. This paper system can only exist when everyone plays paper, when only 2% to 5% of participants request real delivery. But the world has changed. In January and February of this year, the delivery request rate surged to 98%. Yes, you heard that right. 98%. Sovereign funds, industrial corporations, and strong hands no longer want cash settlement. They demand real metal. They want heavy silver bars. They understand that paper contracts can't be used to manufacture solar panels, can't conduct electricity in EVs, and can't protect them when the dollar is losing value. Facing a March 1st notice day that is closing in fast, the big banks that sold short realize they don't have enough physical silver to deliver. If they let silver continue freely above $91, tens of thousands of call options would expire in the money, creating potential delivery demand of up to 175 million ounces, double the actual silver sitting in COMEX vaults. They had only 2 choices. Choice 1, admit defeat, declare default, force majeure, and let silver explode to $150 or $300 overnight. Choice 2, play dirty, shut down the exchange, wipe the order book, trigger a selling cascade, smash price down to scare contract holders into closing positions and taking cash instead of demanding silver. And they chose option 2. History is repeating. This is the same tactic they used in 1980 to destroy the Hunt brothers. When the Hunt brothers squeezed silver to $50, the exchange simply changed the rules. They implemented Silver Rule 7, banning buyers from using leverage while still allowing sellers to use leverage. Price collapsed. The manipulators won. But this time, their opponent isn't 2 Texas billionaires. Their opponent is humanity's real industrial hunger, sovereign nations, and especially the rise of the East. If you still doubt that the paper price in New York is a stage play, then look to the other side of the planet. Look at what's happening in Shanghai, China. While the price on your screen was smashed down to $86 and then $88, iron physical silver at the Shanghai Gold Exchange was trading $12 to $14 higher than New York. At times, Shanghai prices hit $104 or more. That massive premium is ironclad proof, the loudest possible declaration, that the market has been split into 2 worlds, a paper fantasy world in the West and a brutal physical world in the East. In a normal free market, even a $1 arbitrage gap would be hunted and closed by algorithms within seconds. But this 12 to 14 $14 premium has remained standing day after day and is even widening while the paper price recovers. Why? Because arbitrage is dead. Arbitrage is dead. You can't buy cheap silver in New York and ship it to Shanghai to sell for profit, because there is simply no silver to buy in New York at that $88 price. The vaults are empty. The $88 price is just a mirage. China doesn't buy meaningless derivatives contracts. Since early 2026, they have listed silver as a strategic resource. They've tightened export quotas. They are accumulating every ounce of physical silver they can find, with reported reserves purchases as high as 1,000 tons per month, absorbing a massive share of global mine production. When their giant solar panel factories need silver to run, they don't care what the COMEX electronic screen says. They pay the real price to get real metal into their factories. That $14 premium is the Western System Default Risk Premium. The market is screaming in your face that 1 ounce of real silver in your hand is worth far more than a promise on paper. What you witnessed in that brutal 90-minute crash was actually a wealth transfer machine. Weak hands, high-leverage retail investors, emotional traders who panic at red candles, were forced to sell their assets cheap. And guess who was on the other side of those trades? Strong hands, the sophisticated banks, are the institutional funds and long-term physical accumulators. They stood there patiently absorbing all the selling, scooping up liquidated contracts at the bargain price of $86. The proof is that right after the crash ended, silver rebounded powerfully back toward $90. A resilient V-shaped recovery. The drop didn't come from a change in fundamentals. It came from leveraged liquidation. The core problems remain completely intact. A sixth straight year of structural supply deficits, industrial demand for AI, solar, and EVs still exploding, U.S. national debt ballooning, and unprecedented geopolitical risks tightening supply chains, especially the freezing of activity in Mexico, the world's largest silver producer, due to sanctions and cartel violence. Even while the media ignores it, the biggest banks are quietly shifting their price targets. Bank of America's report points to 135 to 309 silver based on compression in the gold/silver ratio. Citigroup talks about $150. They don't throw out these numbers for entertainment. They're calculating from a physical reality. There is not enough silver to meet demand. So what do you do now? First, stop trading emotionally and stop using dangerous leverage. Leverage is the tool they use to destroy you on days like this. When you get margin called, you lose control. Second, recognize that this smashed down price is a gift. It's the last opportunity to get on board before the door slams shut. So don't wait for a deeper pullback because major industrial institutions are building a floor underneath with massive physical buy orders. Most importantly, hold physical silver. Don't rely on paper ETFs, don't rely on futures contracts, and don't rely on unallocated silver accounts. When the system breaks, those paper claims will be cash settled at a price the exchange sets, while the real-world value of silver outside the system will multiply. If you can't hold it in your hand, you don't truly own it. Time is on the side of physical metal holders, while it is the sworn enemy of leveraged shorts. This battle isn't just about money, it's about the transfer of power from a debt-based monetary system to assets with real intrinsic value. The after-midnight smash and the 90-minute exchange shutdown were just one last desperate attempt by a system losing control. Hold the line, be patient, and stay away from leverage and recognize that real wealth lies in the weight of the metal you can hold in your hand. If this video helped you see through the theater happening behind the electronic screen, hit like so this information can spread to people who are panicking out there. Share it with anyone who still believes the paper price is the real value of silver. And don't forget to hit subscribe, comment, number 1 below, so I know you stayed with me to the very last seconds. Invest with logic. Not fear. I'll see you in the next developments.